morning, good day, good evening. Depending on what time you're watching this, I'm glad you're here. My name is Theto Morifi, and I just want to walk you through the next step of the Elliott wave theory, being to analyze it on the chart. Remember, seeing things in a diagrammatic form isn't really easy when you start seeing the real deal. So I just want to walk you through that. Let's get right into it. Okay. So I just opened up a USD ZAR chart on the 1 week time frame, and I've just completely zoomed out. Right, I want to see the whole picture. I want to see the big picture. I want to be able to understand where I'm at in the current market trend and where we're going. So first things first, what did I say? The Elliott wave helps you identify the trends and the counter trend movement. So that's the first thing I'm going to start doing. I'm going to go right here, click my highlighter tool, and I'm just going to start outlining the market. Okay. So I'm going to start by the greatest low ever to happen, and I'm going to start moving from left to right. So the first thing I see is an impulse up, followed by a correction down between 2009 and 2011. Then I see a very strong impulse from 2011 right up to the end of 2015. That is a long time for this thing to rise. Okay, I see another correction, okay, from 2015 to mid 2018, okay, and followed by a little bit of a shorter impulse between 2018 um, to mid 2020. Now, I want you to just keep this in mind. Remember, in the beginning or in the middle of 2020, beginning of 2020, we were struggling or we were suffering from the effects of COVID-19. And this explains the change in direction of the market tanking there. All right, so that's another corrective move for now. Okay, so I understand that I'm currently suffering the consequences or right in the middle of the consequences of the coronavirus, as well as a coincidental corrective move. Okay, so once I have established that, what I'm going to start doing is start identifying uh, my pivotal moments or pivotal points. Pivotal being where was the change in direction in the market. I see one, I see two, I see three, I see four, and I see five. Okay, so this is half my wave counting job done. Remember, there are five impulse waves, okay, and then three corrective waves. Right, three corrective waves. So after identifying the skeleton of the market, I now need to start applying the mathematics and the rules of each and every single wave character found in this place. Okay, so if this is identified as wave one, all right, wave two needs, or the following corrective wave needs to fall between the 6 to 50% to 80%, or maybe even 90% of wave one, but never the beginning. Okay, that is a rule. That is a standard. Okay, so now what must I do? I must apply the Fibonacci retracement tool. Started from the bottom of wave one, right to the top of wave one, or the supposed wave one, and just read off where did the reversal take place. It took place in between the 78% and 90% of wave one. So it fell in between the 78.6% and 90% of wave one, which is valid according to our rules and standards. Okay, so let me just clear that up. And what we do, I needed a text. What I usually do is just identify these with a simple dashed line and followed by a normal bubble. Okay, bubble of identification. There we go. All right. So far wave 1 and 2 are valid. Okay, let's see if wave 3 is a valid extension of wave 1. So bottom, I've got my Fibonacci extension tool, bottom of wave 1, top of wave 1, bottom of wave 2. Now I'm not going to go all the way down to the 90%. I'm going to the bottom of wave 2. Oh, would you look at that? 161.8 extension of wave 1. 161.8% of wave 1 is the rule for the validity of wave 3. Okay, I'm just going to identify that for you, write it down, there we go. And then I'm going to remove that Fibonacci extension. Now, wave 4, what is that Fibonacci rule? It says between 12.7% and 38.2%. And sometimes, in rare cases, even 50% of wave 3. Okay, let's see if those parameters are adhered to and followed here. So I'm going to start my Fibonacci retracement tool because I am trying to determine how deep the retracement went. Start at the bottom of wave 2, top of wave 3, the chart, not the extension level, but the chart itself, and we have a 50% retracement. So this is a rare case. Okay, so we have a 1, a 2, and a 4, and what's followed? A wave 5. So 1, 2, 3, and 4 are valid thus far. What we need to determine is how long wave 5 was. Let's try and determine that. I want to take a fib retracement tool of wave 1 because the length of wave 5 is 618, 100%, or 161.8% of wave 1. So I'm going to use the price range tool to measure these off and be able to transfer them according to the right values. So 100%, 618, and then 161.8 all the way down there. So what we do is we measure these off of wave 4. So it's not 618, it's almost 100%, and 1618 is way higher, so it falls right in between these two levels, and I'm just going to do that. Okay, there we go. Here we go. So remember I told you that the Elliott wave principle, or the theory, evolves or becomes stronger the more you practice it, the more time you spend in the market, the more you see, the more you learn. So this is another trick I have learned. So I take my trend extension Fibonacci tool from the bottom of wave 1 to the top of wave 3 to the bottom of wave 4, and I look for 3 levels, being the 38.2 extension of wave 1 to 3, the 50% extension of wave 1 to 3, and the 618 extension of wave 1 to 3. These are my 3 main targets usually when I am trading the wave 4 to 5 impulse move. And in this case, we see that the 618 extension of wave 1 to 3 was the perfect extension and the perfect target to be used in this case. So I will just identify that there. And now we can do the last thing, the very last thing, which is number our waves. 1, 2, 3, 4, 5. There we go. And I usually, when working on such a huge time frame of the 1 week, I use a high degree so that I'm able to fit all the other degrees, the lower time frames I use underneath. So in this case, I will use the intermediate and the color red or maroon, whichever one makes you comfortable. Right. So we've identified that, okay, we've experienced a whole impulse move. So now what we need is those last three waves. So we understand that we are currently perhaps in this leg or the B leg of the three wave correction move. Okay. So looking at this huge time frame, the 1 week time frame, that correction is going to take years to happen. And we don't have that, right? So what we are going to do is we're going to start scaling down into lower time frames and breaking these two legs up to determine when would be the right place to enter the major sell-off for wave C that would probably bring us down to the level of the fourth wave there. Okay, so we need to understand, is there still potential for the market to go up? Okay, is there still room for that to happen? And that will be determined by the rules that accompany the B leg correction, okay, which speak about 80%, all right, to 90% of, sorry about that, 90% of wave A. Should this be the end of wave A? All right. So that's what we need to determine on the lower time frames. And I'm just going to open a new time frame right now. And what I'm going to do is I'm going to clear everything we see here so that I can open up a fresh time frame. Okay, there we go. I'm going to move from the 1 week down to the daily. And we are going to start observing that leg. Oh, sorry. We're going to start observing these two legs here to identify when can we enter the sell-off, be it here, be it there, be it there, you know, how or when are we going to do it? So in some cases, B leg is 61.8%. In most cases, it is 80% to 90% of wave A. Right, so let's just keep that nice and bold and big at the top. And this is our guiding criteria because we understand that we have wave A complete down here. Right, but now we need to understand, remember we spoke about different structures housing these corrective waves. We have the zigzag, which consists of 5 waves as A, 3 waves as B, and then 5 waves as C. Right. This is a zigzag. And in these cases, where zigzag is involved, wave B is between 61.8% and 80%. Ooh. Okay. So wave B in the case of a zigzag correction usually pulls back between 61.8% and 80%, but majority of the time, and by majority I'm talking about more than 80% of the time, we have a 618 pullback. But then in the cases where we have a flat correction or a triangle, flat correction we have A, B, C being a three wave subwaves for wave A, B, C sub three waves for wave B, and then 1, 2, 3, 4, 5 subwaves for wave C. Okay, and in this case, what do we have? This is what we call a flat correction. Right. So a flat is 3, 3, 5. A zigzag wave is 5, 3, 5. And in the case where we have the flat correction, we have an 80% to sometimes even past the wave A, which is a negative 1.41%. Okay, sometimes it even passes wave A and goes above wave A. That's another variation of a flat correction. All right, this I deal with it in advanced course of the Elliott wave theory. Okay, so now what we have is we have these two criterion to follow. I would include the triangle, but we do not have converging lines giving us converging lines from left to right, giving us a triangle formation in this case. So we will just overlook that one for now. Right, so I'm going to zoom in a little bit, get a feel, and see the chart nicely. Let me just move this information about criteria in a bit. There we go. Okay, so could this be a zigzag or flat correction? Let's find out. Again, I will go back to basics, understanding or identifying impulses and correction moves. Again, corrections are chunky and they take longer to form and they are usually sideways. Right, I am looking at two chunks, two major chunks that are really protruding in this trend. And then before and after those chunks, I see very short and strong impulse moves. Okay, here we go. Nice. So after identifying this, remember what we need to do is come down to our pivotal points. So the end of that, the beginning of the chunk, the end of that, the beginning of the chunk, the end of that move. And then we begin to identify our numbers. Here we go. I see one pivotal point, two pivotal points, 3, 4, 5. Right. After doing this, I now need to go back to the rules and understand, okay, should this be a 1, 2, 3, 4, 5 impulse move? Do they follow the rules for the movement? Okay, start off with the supposed wave 1 and 2. So I start off at the top, the very last high in the move. And I pull it down to the very first low of the move, which is there. And we see that that grazes that 50% mark, right? So I'm just going to identify that. It just literally grazed it. So extension tool, we want to see where wave 3 is. Right, so now we have a problem. And by this problem, I mean, here's the 1618 extension that we have with the wave 3 rule all the way down there. And the chart or the market retraces way before that. Okay, so now how are we going to deal with this problem? We retrace our steps. Okay, so now we start looking at the subwaves of these impulse moves in between these chunks. Are they really those impulse moves? Could it possibly be maybe that, let's retrace our steps, could this possibly be A, that B, and all the way down there C, meaning that we have this type of correction instead of that one. Okay, let's check it out. Let's check out that possibility. Right. So this possibility says that A has the subwaves of 3 moves, meaning 1, 2, 3. Okay, could that be 1, 2, 3? Let's see. What is the retracement of that top over there? I'm going to pull it back, pull it down to that low, and it's 90%. 80 to 90% is wave B. Amazing. Here we go. Do we rule it off as wave 3? If it's 1618, we rule it off. It's 200%. Okay. 1, 2, 3, 4, 5. This is definitely the wave A for us. Okay. I'm going to identify it there. But now, when we put it back there, it tells us that that retracement is a 50%, meaning that it doesn't satisfy the wave B rule of an 80% to 90% or even a 618. So it cannot be a wave B, right? So we cancel that. We scrap the flat correction rule, and we know that now we're dealing with a wave 3 that is not a normal one, being a short one. Okay. So instead of, there we go, wave 3 in this case being a 1618 extension, it is now a 1.127 extension. And then let us see if wave 4 follows any of its rules. Yes, it does. It is a 30% retracement. There we go. So we have a valid wave 1, we have a valid wave 2, we have a valid wave 4. Let us see if wave 5 is any valid. Okay, again, I'm going to measure 100%. I'm going to measure 618. And okay, based on, just looking at it, it's not going to be 1618. So 100% already is way, so it's a lot more. Let's see what 618 says. Okay, 618 falls a little bit short. Just a little bit short. So it does qualify. Can be better. Let us see if that other experiment, well, not experiment, but experience point works. Remember, we're looking at 38.2, 50%, and 618. And 38.2 falls a little bit shy of that 618 of wave 1. Okay, so we have a valid wave 5 as well. The only invalid wave is wave 3, but it isn't invalid completely because it is not the shortest wave in the impulse. And we can determine that by simply measuring, pulling it through, longer than wave 1, much longer than wave 5. So we have a valid 5-wave move to the downside in this case. 1, 2, 3, 4, 5. Okay, so this, I am going to use a different color because it is the subwaves of the major wave A that we were looking at. So I'm going to use a smaller degree and a different color. So let's use black. Let's use the minuet degree, and we are going to have our A at the end of the 5th wave. Okay, we're using the original color and degree of that major 5-wave move we just had. So now we know that wave B is always an ABC move because it is correcting the impulse of wave A. Okay, let us see. What rules do we have for wave B? 618% or 80% to 90%? Right, so we have our first minor impulse there. And so we pulled the Fibonacci retracement of our first minor impulse in this case. And we have arrived at a 618 pullback. Okay, so this is a green light for us to understand we may be dealing with a wave 2. Okay. with a wave B, sorry, or a wave 2. So in this case, we're still speculating, right? Because wave 2 and B are overlapping, B or 2. The distinguisher between whether this is going to be a wave B or 2 is whether or not the full wave impulse of wave C provides us with a 1.618 percentage extension of wave A or 1. So because we're still speculating about wave B or 2, we have also speculating of the wave A or 1. Right there. Nice work. So now what we need to do is we need to Fibonacci extend A or 1, B or 2, and identify where wave 6x1, the extension of 618 is. Okay, it's there. And then we're just going to leave that as it is. Now wave C has a 5-wave impulse move, the same as wave 3. So 3. Okay. So what we need to do is we need to determine when is wave 3 or wave C going to end. Is it going to end there? Is it going to end there? And where it ends, it tells us whether or not it's going to be a wave 3 or a wave C. And that kind of tells us, should we enter this as a sell for long term or not? Or to wait for a short term pullback, which would be a wave 4, and for us to enter a long term buy. Right. I hope you're still with me. There we go. What I'm going to do is drop down to a smaller time frame, and I am going to analyze this leg of wave C or 3. Okay, so that we are able to know what follows next. I'm going to pull down to the 4-hour time frame. Okay, so we have our BO2 there. Oh, sorry. There it is. We have our BO2 there, and we're currently in this impulse wave here. So we have our first impulse, wave 1, we have our pullback, we have another impulse here, we have another pullback, so we expect another impulse. Yeah, something like that. But let's see where this impulse should end. Okay, so again, rules. 78.6 pullback, still a valid wave 2. Okay, so about that. Extension, wave 1, 2, pull it back. Right, valid wave 3, 1618 extension. And I'm going to pull back wave 2, 3. Is it a valid retracement? It is. 38 falls in between the 12.7 to 50% range. Okay, so now we're going to use wave 1 to tell us where wave 5 could end. 100% of wave 1, 618% of wave 1, 161% of wave, 161.8% of wave 1. So if we base it at wave 1, wave 4, sorry, base it at wave 4, base it at wave 4, yeah. We have 3 values. We have 1 here, we have 1 here, and we have 1 all the way up there. Okay. Okay. So the first one, which is 61.8% of wave 1, falls short or in the same line as wave 3. Okay, so this would serve as a wave 5 truncation. All right, but we still need a 5-wave subwave move to give us that 5-wave. So this one, in a sense, mathematically can be disregarded. So the next target we're looking at is, I usually like to round the numbers off to give me a nice round figure, is 16.72950. Okay. Now I'm going to use that experience method that I always use to determine the 5th wave. So bottom of wave 1, top of wave 3, down to the wave 4. Okay, so then I identify wave 61.8 and 50% and 38.2. Again, 38.2 provides us with a wave 5 truncation. Excuse me. Provides us with a wave 5 truncation. Right. So what I am expecting, or what the market is telling me that should happen, is that we should have, or we should experience, a 5-wave move that provides us with a wave 5 that will end in between these two lines, maintaining the wave C structure instead of wave 3. Okay, so instead of this being A or B, A01, B02, this is indeed an A, B, C structure. And we can experience a minor long position for USD ZAR. Okay, we can experience a minor long position from USD ZAR and a long-term position for USD ZAR. A long-term sell position for USD ZAR. Again, remember when I spoke about the Elliott wave providing us with clear invalidation levels? Entering this trade would allow me to place my stop loss at a strategic level, which accommodates for the invalidation of the trade. And by accommodating for the invalidation of the trade, I am talking about if the market retraces to the beginning of this previous low, then I expected to continue down. That means that I was completely wrong about this move up. And that is how we use the Elliott wave system, or the Elliott wave theory. What we've experienced here is now an A, B, C structure. Okay, smaller degree. All right. 1, 2, 4, 5. I'm just doing this very fast right now because, yes, experience. So we have a 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. And this is also to show you how degrees work. Okay. So we have a higher degree, 1, 2, 3, 4, 5 move, but in between this higher degree, we have a smaller degree, 1, 2, 3, 4, 5, ABC market cycle. Do you see that? You see that ABC market 5 or 8 wave market cycle right there. And what we now expect is, because that 8 wave market cycle is complete, we expect another impulse move to provide us with the information we need to complete this 5th wave. I'm going to remove this, and yes, this is the kind of move we are to expect. And I would just like to visually show you the different explanation of how wave 4 and 2 really look the same. See, in this case, we have a very sharp wave 2 move, okay? And we have a very long wave 4 move. So this is, you will see this almost everywhere in the market. If you pay attention to your rules, um, your guidelines, you will see. If we have a long wave 2, we will have a very shallow wave 4. If we have a very shallow wave 2, we have a very long wave 4, so on and so forth. And if we have a very long wave 3, we usually have a shallow wave 4 and a shallow wave 5. Okay, so these are the principles. These are the okay. So in this case, what we can have is when this is over, I can be able to identify, okay, 50%, 618, where will it be a buy if I want to trade this small buy or this short-term buy, where would be the best place to enter? And I would identify that as the 61.8% for wave 2 or the 50% for wave 2. And I know 90% will be the deepest move. Like the deepest move it could have possibly go is 90% before coming back up. And I set my stop loss below, just below 100%, maybe like 5 pips, because you don't want things like spread to take you up. 5 pips, so that if it comes down to 90%, it still has the potential of going back up. But 618 and 50%, that is my entry bubble, 90% of the time. There we go. So I expected to enter this bubble and head up. I'd like to thank you for joining my session. I know we only looked at one pair. Um, I hadn't even prepared anything before this pair, but here we go. We have great analysis. It's a bonus for me. It's clear. It's well structured. It's we adhere to the rules, and notice that I do have volume levels down here because I do also want to understand what the volumes look like at this juncture. You understand? What do they look like? Well, what is happening? Is this a third wave? Indeed, is it a third wave? And that volume pick there is telling me that yes, it is a third wave. But I want you to understand that indicators lag. Indicators are, if you rely on an indicator, you always enter a trade late unless you use it in conjunction with what you have, in terms of a clear system with an edge, a clear system with um, clear parameters, clear rules, and clear guidance principles. Okay, this provides great risk reward ratios, and I really advise that you adhere to that at all times. Thank you very much from Theto Morifi. Um, I'd like to see you next time. Cheers.